Hey everybody, welcome to the VIP Financial Education channel. Appreciate you. If you're coming back, if it's your first time, consider subscribing. This is where we help you go further, faster financially, and we do that by discussing several principles that have truly helped me personally become financially independent. I do what I want, when I want, where I want, for as long as I want, and I just don't have to sweat price tags anymore. And I think based on my experience, that's really what everybody's looking for. I think the semantics vary, of course, but it's truly provided me a life of freedom of choice. And I think that's where money serves us the most, is being able to be generous, be selfish, and be free to do the things that are most important to us. And whether you're somebody that wants to spend your weeknights at your grandkids' soccer games or practices, or you want to travel the world, these principles discussed on the channel have allowed me to do that in my own life, many others to do it in theirs. And today I've got a really special guest on who is living a life of abundance, a life of freedom as well. Somebody that is a new friend of mine. We actually met down in Colombia recently at a really extravagant wedding. I'll throw a couple clips here in the video for you so you can see just how impressive this thing was. It was extravagant, to say the least, and what an amazing time. And having an opportunity to sit around such amazing people too was one of the best parts about it. It was such a good reminder for me. Charlie, I don't know if this was something that you picked up on, but I know you were good friends with so many of the folks there also, that good people surround themselves with good people. And, the bride and groom, who we're both really great friends with, they do that so well that the connections that were made were phenomenal. And this interview I'm really excited about because I had a chance to sit with Charlie for a bit at the wedding and was so impressed by his story that I invited him to come here on the channel and share with you guys what he had accomplished, because I think in a relatively short period of time, when I first heard some of his current results and then reverse engineered it back into, how long he's been doing it, I was certainly impressed. And I think that you'll have some terrific value to share with the listeners here today. So why don't we just kind of start with a real brief summary of your background. I mean, what were you doing before you got into real estate? And then how long ago did you sort of step into that space? Because most of this will be, I think, real estate specific today, if I'm not mistaken. Tell me a little bit about that.
Yeah, thanks, Matt. Really happy to be here and stoked to have met you at the wedding. And it's just always an honor to be able to jump in front of an audience and share my story, and appreciate the opportunity. So how we got started, or what I did before I got into investment management and real estate was I'm an entrepreneur. I always knew that I wanted to start businesses from the time I was a little kid, lemonade stands and like local neighborhood newspapers and things like this. I always had an inclination to do my own thing, and went to college for that. I'm originally from Washington State and went to college out in Boston and studied entrepreneurship. And when I was in college, I launched a travel company, actually, an adventure travel company based out in Italy, where I was studying abroad, to take study abroad students in my class up to the Alps to ski. Now, that was something I love to do, is skiing and being out in nature. And I found an opportunity to do that and get paid basically to go skiing in the Alps. And I was like, this is an opportunity. So basically turned that into my first entrepreneurial endeavor. Ran that for about 4 years out in Florence, Italy, sold it to an investor, and then started another business that failed after a year that was in the same space. And so I got an experience in entrepreneurship and management, was basically in a place where I needed to get make some more money, get some more management experience. So I went into the corporate world and did similar things with all the resources that a big international organization can bring, and had that experience as well. In the meantime, met my wife, who was a financial management. She was a portfolio manager on Wall Street, and we were both working in the corporate world. And I was really yearning to get back into entrepreneurship because of the freedom that it brings you, back to what, you were extolling earlier in the beginning of this. And working for somebody else was hard for me. I had worked on my own accord and had built a team up to 20 people, and had this really fun freewheeling experience living in Europe and taking people on adventurous trips. And all of a sudden found myself working in a large corporate glass building in Boston, and was finding myself kind of stuck a little bit, making decent money, learning a lot about management and corporate, policy and all this kind of thing, but wasn't really doing it for me. And my wife was in kind of a similar situation, but let's say even more strict, even more culturally stifling, because the finance industry is very, very, especially in Boston and New York, it's very straight-laced. So anyway, we were making decent enough money that we could buy our own home in Boston, and that's where we were living. And but on our honeymoon, decided that we wanted to quit our jobs and go travel. And that was kind of a momentous decision for us because it was leaving a lot of security behind. My wife was on the partner track, making great money. I was on a, president track. I was already a director, moving more into up the corporate ladder. And we said, the money and the titles aren't worth it. We'd rather be out living our lives in the world and seeing places we want to see before we get too much older. So we made that commitment. We, after about 6 months, slowly cycled out of, quietly quit, as kids are saying these days, our roles, got our bonuses, and then took off and went traveling. And we spent about 14 months, hit about 35 different countries, bagged peaks in Nepal, scuba dived in Indonesia, skied in Japan, learned how to meditate in India, really had an incredible breadth of experiences that really taught us a lot about ourselves and life and helped us to kind of reconsider what's most important to us. All the while, we were renting our condo in Boston. And that was just like something we just needed to take care of when we left. We didn't really think, oh, this could be a potential income source. It was just like something that we hoped would sort of break even. But it did much better than break even. We made about $1,000 a month off this thing. And when we were taking the Trans-Siberian Railway across Russia, literally in the middle of November, it was like Tolstoyan, freezing cold, bleak, but beautiful. We're sitting on this train for like 7 days and had a lot to talk about. And one of the conversation topics was, how awesome would it be if we had 5 more of these, condos that were producing that passive income? We could basically retire and keep traveling indefinitely. And we had a good friend of ours along the ride with us who had actually already started doing that in Boston since 2010, 2011. So she already owned a triplex, and we owned this, little condo. And she's like, yeah, guys, like, this is passive income. How come you've never really considered this? And it was this sort of aha moment. We decided at that point, let's make this real. So we said, this is going to be our return plan. When we get back to the US, let's build this into a business and scale it up. Let's learn as much as we can, buying small stuff first. And that was the beginning of Akras Capital. We started off building it basically for our own financial freedom. We didn't really think much bigger than kind of selfishly ourselves. Did quite well with our first 4 or 5 acquisitions and built a small portfolio, and then started realizing, like, holy cow, people don't really know that. Not that many people know about this. What can we do to start increasing our ability to buy more, bring more people into the fold, bring investors in with us, bring our family and friends along, which is kind of the original idea. Let's throw the ladder down, the rope ladder down into the treehouse to our family and friends and people we care about, so they can learn how to build this wealth and passive income. And that was how we began scaling Akras Capital. So that was essentially the genesis story. Do you want me to tell you where we've been, or do you have any questions?
Yeah, give me a ballpark year that Akras was initially founded. Then when did you guys essentially start that?
Yeah, so 2017 was when we had these ideas, and for the first 6 months, we got together. My other partners, Christina, who's my wife, and then our other partner, Linying Zhou, who's based in Boston. We all got together in Sun Valley, Idaho, at this beautiful ski resort, and spent a couple of weeks or some time thinking, like, what exactly does this business? What do we want it to be? And we spent then the next subsequent 6 months really studying real estate investing, really understanding, reading every Bigger Pockets article, watching podcasts just like this, reading lots and lots of books. Luckily, my wife and my other 2 business partners were chartered financial analysts, so they understood the basics of underwriting a deal, because they used to underwrite like $100 million deals, $300 million deals. My other partner, Linying, was a corporate bond trader. So she was one of the women on Wall Street, which is unique, like basically taking it to task with all the male traders. And like, it was just, she's a tough negotiator. My wife was a portfolio manager. So she was helping to determine what positions lending would help to create for big clients like Amazon. So I had and she's focused on mortgage-backed securities and kind of the housing space as her sector. So they had this like really high-level macroeconomic view of everything that was going on, and as well as an understanding of analytics and underwriting to like put these models together that would make sure that you start getting paid on day one and you don't buy something that doesn't make sense. So that gave me a lot of confidence as an entrepreneur in our model. And I brought my experience as an entrepreneur building businesses, systems and processes, networking, et cetera, into the mix. And that's how the three of us got going in 2017. We bought our first asset, I think about 6 months or 8 months after we formed the idea for the company.
Interesting. So really, we're only talking about 5 years here, right? And then eight years since you purchased the first condo, which was really how you started to realize, hey, we're sort of sitting on this revenue stream, right? And you at that point were a complete beginner when it came to real estate. You had this condo, you wanted to travel, you resigned from your positions, and essentially it was just, hey, let's fill the space while we're gone. But you start thinking to yourselves, okay, this is actually something we could turn into our next ventures and come back from that trip ready to start to explore it. But at that point, you had no previous experience in real estate, correct?
Personally, I didn't. My wife, like I was saying, did, because she, traded. She worked on, mortgage-backed securities and things like this on Wall Street for about 15 years. So she was a chartered financial analyst and had an understanding. And frankly, she knew a lot more about what she was doing when she bought that condo in Charleston outside of Boston than I did. I was kind of just along for the ride and was really lucky that she bought that thing way below market. She bought it in a growing submarket of Boston, just outside of the financial district. She knew that it was going to raise in rent. So she had a lot of this basic understanding. I mean, she got a HELOC on the thing. Like, she was doing things in a lot more sophisticated way than I was understanding. I was just kind of like, here we go, So she had an idea of the master plan. She was playing, but I certainly didn't. Yeah.
I think that's such an interesting topic, because we did a recent video where we were emphasizing the significance of having the right team, right? The right partnerships. And I think you might be a prime example of that. Not to take anything away from your own intelligence, because that's obvious, but nonetheless, without these two gals,
yeah,
where would you be? No different than me and most of my businesses.
You had asked me in the prep for this to talk about entrepreneurship, the good, the bad, and the ugly. And I would say that, or kind of just my entrepreneurial experience. And what tends to come to mind a lot when people ask me that question is, yes, first of all, surround yourself with people that are smarter than you. Absolutely. And it's great to be in an industry and in an asset class that's predictable, that's been done before. Like when I had a small business before my adventure travel company in digital marketing and search, pay-per-click and stuff like that. And then when I got into travel, like those industries are so cyclical, especially in consumer focused products like adventure travel, which has gotten pretty commoditized. Like there's just no guarantee that the business is going to work out in the long run. It's such a discretionary thing to go on a trip. Whereas people always need the basics. They always need, a roof over their head, food, water, and that's what, apartment investing, multifamily investing is. It's in an always valuable commodity, an always valuable asset. And so having that as my entrepreneurial endeavor and having that as the focus for what we invest in and spend our time in just gives me it's just so much easier than in a particularly risky asset class like adventure travel or something like that. So I'm just thankful for having that. I'm thankful for having my two partners who got this stuff before I did, and for that trip across Russian Siberia where we had enough time to sit around and stew on different ideas for when we got back.
So in 5 short years, you guys have really done some remarkable things. Why don't we just kind of jump to present day so that we can at least understand together as an audience what your existing results look like, so that we can kind of back our way into steps that have led there, and where maybe you might guide people in today's market, knowing that we're dealing with a lot of variables that leave people feeling a little uneasy. And I think consumer confidence is down at this point. Affordability is obviously at a 30-year low. We need to figure out what we could be doing today in order to continue to build our wealth. So why don't you talk a little bit about what your results look like as of today, if you don't mind kind of opening up about that.
Yeah, so since we began, we've acquired both as a small team and then also in partnership with other operators, about $90 million in assets, which seems crazy to me, but also knowing where we're hitting these days, that's actually very small relative to the other operators that are our peers. That might sound crazy. Like 5 years ago, if I saw myself saying, "Oh, we've bought $90 million of multifamily assets," which is like everything ranging from a 5-unit to a 324 unit in the Sun Belt and the Southeast, and now we mostly invest in Phoenix, Arizona. I would say I'm crazy. There's no way that we had that kind of strike range. But the craziest thing about it is that we're now looking to buy assets that are 200 units plus, and that's what we're scaling our business to do right now, which one of those deals alone is like a $40 to $60 million deal. And that's our strike range. And we're partnered with a group that wants to deploy $500 million of capital into our current target markets over the course of the next year. So we're seeing this crazy exponential curve that every time we ladder up and kind of grow to that next asset size, it feels normal almost. It's like, oh yeah, obviously. Like I'm talking about a $10 million asset being like too small for us, which is crazy. So this, you hear it on podcasts all the time. You see it on Bigger Pockets. Like this is an incredibly stackable asset class. This is an asset class that as you get started, and we bought our first unit was a 5-unit. Okay. So just to be clear, like our first asset that we ever bought was a 5-unit asset. I think we bought it for $250,000 in Spokane, Washington, in the east side of the state. It was a 4-unit old Victorian home that had been cut into 4 units. And then it had a small postage stamp single family that was acting as the 5th unit on the back, kind of adjacent property. We bought that thing. We split off that single unit, turned it into a single family fix and flip, and then fixed up that 4-unit and rented it and held it for a bit. And then the appreciation and cash flow were great. We sold it, I think, a year and a half later. We had an infinite cash on cash return, after because we got solar financing. So anyway, our first deal was kind of a crazy lucky deal, but I was lucky to have my partners who recognized the value in it. And since then, we bought an 8-unit, and then we bought a 12-unit, and we bought a 20-unit, and then a 23-unit, a 26-unit, and we stacked those together in a portfolio. We bought a 111-unit and 324-unit. Like it just really kind of exponentially grew in terms of our kind of our striking range and our ability. And a lot of it's because we had increased experience. We had a different balance sheet that allowed us to take out more debt. We partnered with other operators who had, big, wealthy loan guarantors and access to lenders that allowed us to get agency debt on larger assets. So all the relationships that we built over that time helped us to increase that striking range. And like I said, now we're looking to buy 200-unit plus assets exclusively. Newer assets to 1984 and newer. So we've mostly bought, stuff that's a little bit older than that in the past. And I'm so grateful to have that opportunity and to have gotten to this place. And it took some effort, but it's not totally out of the realm of possibility. Does that help?
Absolutely. Are these long-term buy and holds for you? These multi-unit?
So our overall strategy is long-term buy and hold. And we want to be holding these things into perpetuity. That said, as we've gotten to that point, in order to stack our portfolio, in order to increase, our balance sheet to be able to take down bigger deals, we have had to exit deals in anywhere from a year to 3.5 years or something like that. So certainly like holding them is the ultimate play. That's how you're going to build the most wealth over kind of the long term. But in our kind of hyper growth mode that we were in, we really needed to sell those things, realize that appreciation, bring that capital back into our business as working capital to acquire the next asset. And so that's the end goal, though, is to hold them into perpetuity.
How many doors do you guys have now?
So we're in a little bit of an interesting place because we're actually low on our door count. We sold 2 assets in the last 6 months. So we were just around 500 units, and we sold a 324 unit and 111 units. Now we're like, I think we're around 60, 65 or something like this.
Okay. Back to the beginning.
Yeah. Going back down. Now we're looking to deploy into bigger stuff, right?
Right. Just a lot more money available. Well, that's exciting. So how has debt played a role for you guys? How have you managed to lean into leverage throughout this 5-year period? Tell us a little bit about what it would take for somebody to scale up. If you're starting at the launch pad, you want to get up into space. Where are we at as far as utilizing OPM for this to happen?
Yeah, so it's a great question and a good analogy that actually my team uses all the time. The kind of launch blast off escape velocity analogy. So when we first got started in the first, let's say 3 to 4 years of this business, it required a ton of resources and a lot of time. We had to dedicate tons of time into research and understanding all this, and a lot of time in the markets, driving around, understanding, a lot of time talking to bankers. How debt played an initial critical role in our business was we got a unsecured line of credit with a local credit union in the first market that we chose to invest in. Our investment thesis is inland growth markets. So we invest in secondary and primary cities that are experiencing huge population growth and rent growth because people are leaving the coasts and moving inland. So that's our investment thesis. Our first market was Spokane, Washington, which is seeing a lot of growth from Seattle, Portland, San Francisco, et cetera. People are moving in because it's cheaper. They can get, even hold the same job that they had in Seattle or San Fran, which has that big salary, buy a cheaper home, maybe even some investment properties and have a higher quality of life. So that was our investment thesis. And so we went to Spokane, which is also my hometown, and began building relationships with local bankers. And that started off with a credit union. This was, obviously 2017, 2018, a little bit of a different economic environment. But based upon our balance sheets, based upon my wife and my other business partners' experiences as chartered financial analysts on Wall Street, they were able to, and I guess kind of the overall pitch of our business to make impact in the communities that we invest in. That credit union saw us as an opportunity and gave us a $500,000 line of credit. That was what we used to buy our first asset in Spokane, which actually, I should say the first asset that we bought was with seller financing. So the owner wanted to carry a note, and they sold us the asset with that note because their main goal was cash flow. And they're like, well, if we can make $1,000 a month, I think it was $950 a month, and give you guys the control and ownership of the asset, then we're happy. And we're like, awesome, we'll do that all day long. So our down payment was really low on that. We actually didn't even have any debt with any institutions. It was just from that seller. So actually, to your point, that was a really interesting usage of leverage on our first deal. The second deal was propelled by that unsecured line of credit that we got. And the third.
Do you mind if I ask a couple of questions about that, just because it relates well to our channel here, right? We talk a lot about these types of instruments. Tell me a little bit about that $500K, if you don't mind, if you remember, in fact, because I know this was some time ago. Was it? I'm sure it was personally guaranteed, right?
Yeah, it was personally guaranteed. It was unsecured. Okay. So, yeah.
So we've got, obviously, credit made a big impact for you guys there. I'm assuming you came into this proposition with a paper borrowing strength from a credibility. Great. Yeah. So obviously you would recommend that people manage their borrowing strength well. I mean, we 100%. Have to understand this is step one. If you're not paying your bills on time, if you're not able to show that you're somebody that repays your loans, you're going to have a much more difficult time building something organically than you could going out and getting access to what a phenomenal tool, $500,000 unsecured, not an easy tool generally to get for just the average person. Yet I'm also a little curious how much the networking and relationship development that you built with the credit union impacted your ability to get that. Of course, it sounds like, your wife and your partner's backgrounds certainly didn't hurt anything in that conversation. Yeah. How about the average person? Would you be able to walk into a credit union today or a bank today and actually develop that type of almost a preferential treatment. And that's kind of the old school way of banking. We used to be able to relate, build relationships. Now with the big boxers, especially, it's nearly impossible. You're just a number. They don't care about anything.
Yeah.
What would you say the relationship between, that networking and your ability to qualify was?
Yeah. So it was definitely important. We spent time, having coffees and lunches with the private banker at this credit union. And I would say first and foremost, we learned about credit unions from a local investor there who had done similar things. And, of course, there were other banks in that city, including national, chains. And the nationwide chains didn't have any interest in what we were doing. And even the local kind of regional banks didn't have any interest in doing what we're doing, or they did, but their rates were onerous and they needed secured lines. And we didn't have any income, by the way, because, we didn't have any W-2 income. We had that 1.5 year gap in between employment from, reputable companies and on Wall Street and what I was doing and what we were doing then. So
earning rents. You got this seller finance property and you've got a condo you rented for a bit. And other than that, okay.
Yeah. They look at global incomes. They looked at all three of us and what income we were making from all the properties we had, or the very few properties that we had, like our place in Boston, my partner's triplex in Boston. They looked at that rent, but it really wasn't enough to make it happen. It ended up being, but it was also a combination of our own, persona. We kind of did a pitch on what our business was and what we were looking to do. And I was from that city. I went to, elementary school, middle school, and high school there. And I saw affordable housing as something that was needed. And we said, this is what we're doing. We're impact investing. We want to make an impact in this community, and in a very kind of small way. And because it was a credit union and because their mandates were to make an impact in the community and lend to locals in the community so that they can make an impact, that spoke directly to their mandates and their mission. So that would be, I guess, a takeaway tip is start with credit unions. Credit unions are great. They want to help the local homegrown folks that are there. They want to help invest in the backyard. In fact, we don't have that relationship with them anymore because we sold all of our assets in Washington State and redeployed into other markets. They won't extend us that line of credit anymore because we're out of their footprint, which just shows that they're very focused on, their footprint and making an impact there. So that's fine. We moved, we grew beyond needing to use them, but at that time, it was absolutely critical, and building that relationship with them on the ground. We were living in Boulder, Colorado, which is where we live now. And my other business partner was living in Boston, and we had to fly out there and learn the market and drive everything and know what was going on. We were like racing in the local 10K and visiting my family and, building a relationship with these bankers all the while. So it's old school, but it makes a difference. Would we be able to get an unsecured line of credit today in today's lending environment? Probably not. And here's another takeaway for folks that are getting into this. If you have a W-2 job that has solid income, and you're looking to get into investing on your own, where you're going to buy your own assets and you need to take out leverage in order to do that, hold your W-2 income and that safety that the banks feel really good about as you transition into this. Like, I would hold that literally, even if your job is like terrible, you don't like it anymore, keep it so that you can have that income that you can represent while you're applying for these different lending products, because it will make it so much easier. If we'd had our W-2 jobs and gone right into this, we would have been able to probably get that same kind of loan product. But we really had to do the whole dog and pony show about who we were and what we were doing because we had that gap in income. So that made it difficult for us. We're so lucky the environment was what it was, and banks were like very happy to deploy debt at that time. It's very much a different situation right now. Banks are nervous. The hawkish Federal Reserve is continuing to increase interest rates, and lending is getting more expensive, and they're being more careful about, debt service coverage ratios and loan to value. That stuff is much more. They're much more careful. They need that asset to collateralize the loan. You can't just get an unsecured line of credit without having something to back it up. So
sure. Yeah, it's true. I actually was just able to secure a $300,000 unsecured which I did end up ultimately collateralizing in order to not have to really go through any of the documentation process. It just simplified the process for me. The stuff is out there, but you've got to get a bit more creative about it. Much like you did in the beginning when you were starting off and going through a seller financing. There are those types of deals still around for folks that have found it difficult. And I couldn't be more on the same page with you about having your W-2 position really help you progress to a point through the transition versus just cold turkey quitting like you guys did, because it does make it a lot more complicated. Most of the time, as a lot of people probably already know, a 24-month history is usually going to be sort of a typical conventional requirement. And if you don't have at least 2 years of alternative income streams, you're going to have some challenges of being able to borrow. So going into that, you sort of mentioned a bit of today's volatility. What are we really facing? If you were to go back in time and you're 8 years ago, but the market looked like it does today, or even 5 years ago, what would you know now that you could have used then? And would you go about things the same exact way? I mean, if somebody's listening today and they're thinking, hey, I would love to kind of follow in the footsteps of Charlie Stevenson here, and we know that you started with a condo and you then bought a 5-unit, and then you just continually kept expanding this process into bigger and bigger multifamily. Could you replicate it in today's market?
Yeah, it's a good question. And I think the answer is definitely. I think we built this business on the premise, and one of our other parts of our investment thesis is we are not market cycle dependent for our acquisition efforts. Certainly, we're going to be sped up or slowed down by deal flow and quality deal flow, but we want to be growing and acquiring, in any environment. The fact of the matter is, while we were lucky to be catching the tail end of that big appreciation upswing. We were so lucky. We were about 2 years into a continued really big upswing growth, which helped to appreciate our assets in a really rapid way and helped us to then sell them to a really strong buyer's market as a strong seller. So we had all that wind in our sails, which just gave us a huge amount of then, capital to then deploy into the next bigger asset. But even if there isn't that really strong both seller and buyer's environment, like we're kind of experiencing a little bit of like slack right now, there's still opportunity. That not every buyer has the same motivations that are market related. There's distress in every market cycle. There are going to be did I say buyers? I mean, there are sellers, there are owners out there that have different needs, that have motivation to sell at any stage in the market. And while deal flow has certainly slowed down, marketed deal flow from tier 1, tier 2 brokers has definitely slowed down. There are always going to be ownership out there that have some life event or some change in strategy that is going to dictate a need to sell. And that's the kind of the opportunity that we see right now, which is finding those particular scenarios. Maybe they're distressed, maybe it's some kind of a management issue or a change in allocation that they're going through, where they need to disposition a 200-unit asset. We heard a story not that long ago about a group that was a development group, and they developed large multifamily assets, and they decided to get into multifamily repositioning, which is what we do. We buy existing assets, fix them up, and hold them and or sell them. They got into that and realized that it wasn't in their core competency, and they had this 1,000-unit portfolio and needed to get rid of it. And they're like, we want to stay focused on development. That's our bread and butter. So let's get out of this as soon as possible. We're willing to sell, as quickly as possible. We don't need to wait for the highest possible bidder. We have our numbers in the pro forma. Let's hit them and go. So there are opportunities even like that. It's not even like it was distress. It was just a change in investment thesis. And so, change in direction. So I guess to answer your question more succinctly, there's always opportunity. There's always distress in the market. There's always times to enter into the market. You might have to work a little harder. You might have to put a little more energy into finding those deals and off-market deals. You have to put a little more sweat into it. But there's deals. And so, that's how I would first of all, affirm myself and give myself confidence to continue. Having, if I was to talk to myself like from then to now, but also, just keep at it, keep learning. That, if you just give up, like, then there's, no ask, no get. Like, if you don't keep building and keep working and trying to figure it out, then you're going to have the same thing that you have now, which maybe is okay, maybe it's not. So
let's talk a little bit about the effort involved with that statement. So often I just perpetually hear folks coming in and wanting this dream of passive. If I had $1 for every time I heard that word used, I would have plenty of passivity myself. I'm wondering where this idea was sort of originated, because it's so often associated with real estate. And I find it extremely hard to believe that you guys have gone out there and created this life by being passive about it. You don't end up with 500 doors without a ton of hard work. What can somebody expect that's trying to build a portfolio of that size, or even just enough of a portfolio to create the lifestyle of total independence? What really is necessary here? What can somebody expect on a day-to-day basis or a week-to-week basis? Can you truly break it into sort of a, if you don't invest at least 10 hours a week, if you're not putting at least 20 hours a week in, is there a way to narrow that into a bit of a more tangible number for people listening?
Yeah, totally. So yeah, what we do is not passive investing. We bring investors, limited partners into our deals who truly are passive investors, and they're earning passive income from what we're doing. But passive income means you literally are doing maybe nothing more than at some point signing some operating agreements and wiring your money, and then you're getting some kind of a distribution on a quarterly or monthly basis or something like this, and then the lion's share of what you of your return at the sale. So that's truly passive, and we bring investors into our deals so that they can earn passive income. What we do as operators to build this business is by far like as active as it gets. We've got 3 partners, we're full-time on this business. We have, meetings every single day. We have a structure, we have systems and processes that we've built to manage ourselves, manage our goal setting, manage our key performance. We have, KPIs, key performance indicators that help us to make sure that we're focusing on the right things to produce the results that we want in our business. There's a lot. We've built a big mechanism that requires a lot of active work to maintain. It's gotten easier over time. And you were talking about kind of like rocket ships launching off. We use that analogy all the time. Like when you first get going at this, when you see like a shuttle or the SpaceX thing, I always think of the original shuttle on those big orange, that big orange structure, the huge gas tanks. So, for back in the day when a shuttle needed to leave Earth's atmosphere, that little tiny white airplane looking thing riding those entirely huge orange gas tanks, that's what you need for the first couple of probably 2 to 3 years, I would say, is you need those big gas tanks. You need to be putting a lot of time into this. You need to be networking and hustling and meeting as many people as you can. You need to be attending conferences and paying for conferences. You got to be spending money to eventually make money. And yeah, the first year or 2 or something like this, like most of those assets you buy probably aren't going to be like humongous cash cows. They're probably going to make enough to get by, maybe a little bit more. But if you can make $100 per unit, on what you do, you're doing really, really well on a monthly basis. We definitely didn't have that kind of result from the beginning. So we were investing a lot of our own money and a lot of our own time into this business, and we still do. But for the first 2 to 3 years, that was an immense effort to get to the place where we started to realize, quote unquote, financial freedom or truly passive income. And as we grew our balance sheets and started making more money and built some wealth, then we started deploying it into other things personally, in addition to what Akras Capital buys. So we deploy capital into a liquidity fund with one of our partners, and that produces a 10%, monthly return. We put some money into a development project in Boston to basically convert an old apartment building into a condo conversion, and we made some money there. So we started having more capital that we could then start deploying into different things, and those things were producing truly passive income for us because we were then investing in other people's projects as well as investing in our own assets, which were producing passive income. So while there was a major active component to it, to our business, and still continues to be, the wealth that we were starting to accumulate started to actually produce passive income for us as well, which we now really enjoy, and it pays for all of our expenses and allows us to go and travel and spend time with our family. And like you were saying earlier, not have to sweat, a price tag. And that feels really good when you've got that foundation, and then everything you're making on top of it can be used to deploy into other investments and to fuel our existing business and to make impact in places in the world that mean the most to us. So minimum 40 hours a week, at first, a lot of travel. You're spending, a lot of money conducting due diligence, educating yourself on how to underwrite deals by attending boot camps and workshops, and going to conferences to learn as much as you can from your peers and creating partnerships. All that requires money and time. And, I don't know that there's other ways to do it. People always say, oh, I want to get rich quick, but real estate is get rich slow, but you got to start doing it. Push through that energy barrier that might be there for you. All those, thoughts and feelings that says, I don't know that I can do this. Because once you start doing it, and once you start seeing a little bit of success, it really starts to fuel you. And then when you start seeing impact on people's lives, whether it's the investors that you bring in or on the places in the community where you're actually, making an impact on the workforce housing, then it really starts to fuel you. And, and then eventually you drop those huge orange shuttle gas tanks, right? And the shuttle is just outside the atmosphere, and it just requires a little bit of like gas here and there. Like now, like where we are now, our team works as much as we need to. That's about 4 days a week is our current focus. We could have gone a little bit less, but we're now in a big scale up. So we actually have increased the amount of time that we're working on the business and taking care of our investors and our stakeholders so that we can grow bigger and make a bigger, more outsized impact. So we found that when we went down to for a period of time, like a quarter, we went down to 3 days a week or something like this, and having that much time off, we felt really empty. It felt really empty to us. Yes, we were traveling more. Yes, we're having fun, but we didn't feel satisfied. And that would be, I guess, another takeaway, which is when you start to experience that financial freedom and start to have that wealth, get busy, being of service to other people. That's where true happiness lies. Get out there in your community, donate some money, start working with Habitat for Humanity, make sure that you're taking good care of your residents. Don't be a slumlord. That's where the true satisfaction comes, is from being of service to other people. And that's how we've reoriented our company. Really, in the last 6 months or so, we've made impact the tip of the iceberg. That's not the tip of the iceberg. The key performance indicator for our business. Certainly returns, assets under management, revenue are important to us, and investor satisfaction and resident satisfaction. But we want impact in the communities that we invest to be what ultimately drives us, and ultimately what Akras Capital produces in the world. So there's a long.
Who asked questions? I know you've got a couple cool things that I know that you want to make sure to share as well. I had a couple questions for you, if you don't mind. The first is, when you talk conferences and education, were there any specific resources that you might want to share that you felt really changed the direction for you, or really ignited you, that gave you information that sort of changed how you went about doing things?
Yeah. So there's a conference that we went to that helped us to move beyond the smaller sub 20 unit assets and into the much larger space where we could do much larger deals and scale up. And that was Joe Fairless's Joe Fairless's best ever real estate investing conference, or best ever syndication conference. We went to that here in Denver, where I live, years and years ago, and learned a lot about what our peers were doing, learned about the process of syndication, and what that means and how to do it, and built a professional network to support syndication. And we built some relationships with some other operators who we then partnered with on acquiring the larger deals. And not too long after attending that conference, we went into partnership with this group and bought a 324 unit in Orlando. We were a small part of the GP. We were not the lead sponsors on that deal, but it was what allowed us to watch them and learn from them, and also deploy capital and build our investor network capability to bring, capital and experience to that deal, and really stare and compare and see how is running a 300 unit different than running a 20 unit. What's the similarities? What's the differences? What would we need to do in order to be the lead sponsors on a 300 unit deal? What relationships do we need to have? What track record needs to be in place, et cetera. So that Joe Fairless conference that happened in Denver was a great investment. I highly recommend it to anybody that's looking to scale up. And then that was kind of one of the inflection points for us, for sure, was attending that. We've been to it a couple of times, and so I would share that resource for sure.
Okay. Any books that you would point people to?
Certainly, Matt Faircloth has a couple of really great books on syndication and capital raising. Joe Fairless's best ever syndication handbook was really great for us. What else have we? I mean, we're constantly reading books about even how to organize your income. Like Profit First was a really illuminating book for us on how to make sure that we're paying ourselves and not just taking everything that we earn and put it right back into our business, but how do we reward ourselves? How do we ensure that our groceries and our financial freedom is being taken care of, as well as our tax liability, as well as our operating costs, of the actual asset itself. So that's another one I would highly recommend. I could keep on going, but yeah, there's a couple.
I know you have an opportunity too through Akras. Talk to me a little bit about what it might look like if somebody wants to reach out to you and work alongside you.
Yeah, thanks. So, I mean, where Akras is right now is we're making a big scale up leap, jumping into the much larger asset kind of acquisition kind of realm. And in order to do that, we want to bring folks along with us for the ride. And there's a couple different ways that folks can join us in scaling up. One is by being a passive investor with us. I'm building our investment capability now. So if you're an accredited investor and want to learn more about what Akras is purchasing and earn a solid risk-adjusted return, would love to have a conversation with you. You can connect with me, and I think my contact information will be listed in the YouTube channel description. But my email is cstevenson@akrascapital.com. If you're an investor and you want to just see what we do, our website, akrascapital.com, is a place you can go and learn a little bit about the types of properties that we buy. There's also a ton of resources there for you to see kind of what syndications are and what kind of returns you can expect. We have an ebook there you can download. Another opportunity is we're looking to build our networks in our target markets, which right now is Mesa and Phoenix, Arizona. So if you're in that market and you want to be a hustler for us and help us find deals, off-market deals, we have an awesome program that rewards and compensates people for bringing us deals. We're also looking for on-the-ground partners to be folks that go and look at the deals when they come to us, help us with asset tours. And that's going to require a little bit of experience and understanding of what to look for in buying one of these big assets. But certainly we want to be building that network in Phoenix and also in the Carolinas. So if you're in South Carolina, North Carolina, and you want to connect with us about potentially joining on and supporting us in some way, I'd love to have a conversation with you. And again, my contact information will be listed in the description, and happy to have a conversation. You can find me on LinkedIn and our website all over the place. So yeah, thanks, Matt. I appreciate the opportunity to kind of share with folks what we're up to.
Of course, that's awesome. Is there anything else that you can think of that you want to leave everybody here with today that you believe is imperative to somebody being in real estate in this crazy time? I feel like we've covered a lot of territory, but if there's any final parting words that you think we've missed, I'd love to hear it.
Yeah, I mean, while there's a lot of volatility in the market, and especially when you look at craziness and the stock exchanges and in crypto and all that, real estate continues to be an awesome, stable place to invest. There's been, anywhere from 5 to 20% drops in basically acquisition price, which to me spells a big opportunity. So this is a time to potentially even jump in and test things out. If you're just looking to get into real estate and don't want to necessarily be the operator and buy yourself, jump into a passive investment opportunity with a group like ours. That's a great way to learn. We began investing passively with some of the operators that we partnered with right away because we learned a lot about how to operate investor relations and what they look for. Just reading offering memorandums teaches you a lot. So get involved, even if it's $50,000 and throwing it into a passive deal. You're going to learn a lot and park your capital in a safe place while the rest of the financial world goes up and down and up and down. So just get started.
What type of a return can somebody expect on a fund like that?
What's a range? It really varies depending upon your kind of risk level. Anywhere from, I think, a 10% to a 20% return is something that you could, respectively look for right now. We tend to set expectations anywhere from 10 to 15%, 10% cash on cash is sort of our target or something like this. And, but, we always say, be careful for the stuff that has the really crazy returns, like really dig into it, really make sure you vet the operator, make sure you vet the business plan. You don't want to be investing in stuff that has only the best case scenario outcome as the baseline for performance. There's a lot going on right now, and you need to make sure you're getting the right debt. And if you're not getting the right debt, you could be along for a ride. So, and there's a lot of other things that can mess up a deal. So make sure you invest with an operator that you trust, that has really actually conservative underwriting. And but don't be scared. Get in there. Don't wait to buy real estate. Buy real estate and wait. That's the old adage that I like to share. So,
okay, perfect. I love it. Well, look, I'd love to bring you back on at some point if you're open to it. It would be really cool to see how you guys end up deploying this money that you're sitting on right now. I'd love to see how these new bigger deals that you're looking at all work out for you. But a lot of what you said is so invaluable, and the fact that you've been able to accomplish what you have within a 5-6 year period of time is really quite outstanding. And we always tell people, if you're willing to hustle 10 years or less, you should be able to get into a point where financial independence is completely achievable. And you're proof. So I respect it and really appreciate you willing to come on and open up. I know it's not always comfortable to share your personal specifics, but you've been very generous.
Yeah, thanks, Matt. I'm just grateful for the opportunity and grateful for what we've been able to do, and hopefully it's inspires people that anybody can get into this. Somebody, even someone that's never done anything in real estate before, has any really true investment experience, but partner with the right people. Partner with the right people. Surround yourself with good people and partner with them. And happy to come back on and happy to be a service to you and a resource to your listeners. So feel free to reach out to me. Please do. I'd love to just have conversations with other investors and people getting into the space.
Absolutely. We'll go ahead and throw Charlie's contact information in the description below. So make sure you check that out if you guys want further details about what he's up to, or if you're interested in potentially participating in that too. Guys, I certainly appreciate your time for checking this out today. Charlie, once again, thanks again for all your generosity. And until we see you all on the next one, guys, make it a great day and keep on cash flowing. See you around.
Cheers. Thanks, Matt.